how much of the Fed and rising rates is really the story here? Because we talk about a lot of tech. When it comes to big tech, companies like Google, Microsoft, obviously they have very stable businesses, and even things like cloud, there's clearly a transition going on. So are there any other factors leading to this tech wreck other than rising rates?
Obviously, you had the supply chain constraints. I can't blame that on the Fed, but I can blame literally everything else on the Fed. I mean, Jay Powell is driving the economy into a brick wall and has become a liability at this point. I mean, we were expecting, a recovery in the back half of this year, but since that Jackson Hole meeting and the subsequent Fed meeting last week, that entire calculus has changed. And right now, I mean, you look at that. You talked about the inversion in the yield curve. I mean, it is more inverted now than it was during the dot-com bubble. That poses huge risk to the earnings. So as we look at the tech sector, we think that the broader indices, the Qs included, are at substantial risk as the earnings risk continues to rise. But that being said, we are focused on a much more surgical approach on the companies with the most indestructible, the way we frame it, indestructible growth curves. And those are the cloud-first companies that either help enterprise move their data to the cloud, secure the cloud, or change consumer behavior.
All right, so you say the Fed and Powell are the problem, but what's the solution? We saw a company like Adobe make a deal to acquire Figma for 50 times AAR, or as a lot of people consider it, just forward revenues. But the market just didn't seem to like that deal. But obviously it was focused on growth and keeping that company away from competitors. So if investing in growth's not the solution for these companies, what is?
Well, no, I think the Adobe Figma deal was construed unfairly. I think it was a smart deal for them, because Figma is a platform that's going to be the defining operating system for design in the future. Adobe needed to make a move. Adobe is a service, and the world is moving, and increasingly the value will accrue to platforms. So they made a move. Obviously, it will take time to play out in terms of accretion to the bottom line, but it was the right move to make. But the Fed has completely changed the equation on what is the economic health of this country and what will it be for the foreseeable future as we look into the next 12, 18, 24 months. And that calculus has changed, where the tech opportunities and the shift to the cloud continue to remain resilient and strong. That's where we are continuing to invest big and gross up those positions. But we are going to be completely hedging out the rest of the portfolio, given the macro uncertainty backdrop that we're dealing with.
All right, so one question a lot of people are asking is, where's the bottom for tech? Just a few weeks ago, we saw rates rising and also tech rising at the same time. A lot of people thought, hey, maybe we hit the bottom. What do you think?
I don't think, I mean, if things keep going the way they are and there is no about face from the Fed, I think we can go a lot lower from here, possibly 20% lower from here. So, you have a substantial earnings risk. You have the push-pull between these legacy and new tech, which will continue to, create friction in the market. And you have the supply chain, which is, not being fixed anytime soon. For some reason, the Fed thinks that, the demand destruction is going to help the supply chain problems. It's not. So at the end of the day, everything changed at Jackson Hole, and it's really quite frustrating as an investor to have to deal with it, because we were, if they did nothing, that would have been the best possible outcome. But you have to be surgical. I would say keep a lot of cash on the balance sheet. We're continuing to do so to take advantage of any pullback. But you got to be careful here. It's tricky waters.